you don't need a lot of time in these stocks. They can make moves and make very big moves in relatively short periods of time. And the earnings are so influential that this was something that example that I always love showing. The NASDAQ went into this incredible bear market. If those of you who are around in 2000 to 2003 can remember, I mean, what a devastating, this is the worst bear market up until that point that I had ever seen. I went through the 87 crash. This was just unbelievable. The average stock, like Microsoft and Qualcomm and basically the FANG stocks of that era were down about 85%. And many of them still haven't come back to this day. 20 years later, they're still haven't gotten back to the original prices. Take a look at Apollo Group. We looked at this before. If you remember, Apollo Group was the one that was trading at 60 times earnings, had those 3 years of earnings growth that 3 years later, the stock was up 200%, and the PE was exactly the same at 60 because the stock went up 200%, right? Well, look at this move here from 2000 to 2003. This stock makes this big move, right? And it's in one of the worst markets in the history of the stock market. So even now, I'm not saying that you want to start going crazy and getting long in a big bear market, but this is the power of having accelerating earnings, what can happen and what it can do to a stock, even in the face of a difficult market. So now here's another stock. This is Home Depot. Everybody knows Home Depot. But I'll tell you, back in the 90s, it was particularly in the early 90s, Home Depot was not a widely known name. It didn't really get really popular until you got into the mid and late 90s. And this is actually a funny story that I've told. Some of you may know that I was an advisor to the traders over at Soros Management. And I went to go meet with, George Soros's people. And what happened was in the middle of the meeting, a manager came in and said to me, "What do you think of Home Depot? We're thinking about going long the stock." Now that was right over here after the stock had run up extensively here, and the earnings started to decelerate, and the stock started looking toppy. So he said to me, "We're thinking about going long, really, really aggressively Home Depot." And I said, "Long Home Depot? That stock has made a huge move. It looks like the earnings are starting to top of the stock is in stage 3, almost a stage 4 downtrend." He said, "Hire that man, give him a check and hire that man. I was just testing to see if I could influence your decision." So I stuck with my guns, and I told the truth. I didn't try to placate them, and it paid off for me. But what I was looking at the time, okay, here's the moral of this story. Take a look here at the EPS right here. You're at 24% average EPS growth right here, right? Look at when you make this accelerated move. You see how the earnings accelerate? 37, 41. Now your average EPS is 39% for those 2 years. We're looking at annuals now, by the way, not quarterlies. We're looking at annuals. So through this whole move right here, your average annual EPS are up 27%. Now, the stock goes into stage 3 and then into stage 4 downtrend. And in typical fashion, the bad earnings come later on, once the stock tops. Now, looking back in hindsight, it all makes sense, right? The stock tops, and for 2000 all the way out to 2008 here, 8 years later, the stock is still down almost at the lows and has gone nowhere but down. The earnings are about half of what they were through the period where the stock was marking itself up. And you can see way over to the right, this is where the earnings really start to come off here, just 3%, 8%. The stock has already discounted that, and the earnings have already averaged 15% versus 39%, less than half the earnings growth. So again, whether you're looking at annuals, quarterlies, you're looking for acceleration and trying to avoid the deceleration on all those time frames.
Yeah, and Mark, I see this a lot happening, especially in bull markets where stocks, they have great earnings growth, and they take the valuation of these companies up so high that, going from 27 to 15, I mean, that's a pretty big slowdown, but the company is still growing somewhat, but the stock gets so far ahead of the earnings that it takes a number of years for for the earnings to actually catch up to the valuation of the stock. And then the company usually has some problems, and they sort of have to reinvent themselves, or or come up with new products or new services, and then they take off and go again. But I see that happening in even some of the best companies that have multi-decade type of runs.
Right, and that is a great explanation for why we would sell on. David said earlier, we sell on technicals, not necessarily the fundamentals. We don't wait for the fundamentals if the stock's topping, because what happens is, like Dave said, this stock will discount and run way up real fast and top out while the earnings are still looking pretty good. And this is why when we'll roll back to the beginning, what I said, never trust the numbers, never trust the story unless it's confirmed by the price. So that works on whether you're just getting into a position or even whether you're going to justify holding the position. If the stock price isn't acting right, you're not going to hold it just because the earnings are good. But it's when we put all these things together at the right time, you get what I call the specific entry point, and that's what SEPA, specific entry point analysis, is about. Let me show you another way, okay, to look for acceleration. And these are all things that are going to be picked up and are going to be used by institutions. Institutions will run all this analysis, and it's going to all be basically around these techniques that I'm showing you. And here's the real key. You are an individual investor. You can make decisions very, very quickly. So you don't need superiority of information. You don't have to have information that's better information or inside information or any kind of informational superiority, because you have superiority of liquidity and speed. So what takes an institution weeks and months to make a decision and to buy a stock, it could take you literally a half hour. You can make this decision very quickly. What happens with an institution is they find a stock, their analyst starts following it, and then they say, hey, this stock looks like, they're starting to get earnings are accelerating. They bring it to the manager. The manager has to take that, and the analysts have to take that to a meeting. They have a meeting about it. It goes on an approved list, and from there they got to build a position. Usually they got to buy hundreds of thousands of shares, if not millions of shares. It might take weeks or months to build that position. It's a whole process that it's very lengthy. And this is why, 80% of managers don't beat the S&P 500, because they're handicapped by size. You have this incredible advantage where you can look at the exact same numbers and have the exact same tools, but you're lightning fast. Think of it as a big cruise ship and you have a speedboat. And if you want to turn that ship around, it's going to have to make a big, giant turn. Meanwhile, the speedboat, boom, turns around in a second, is going in the other direction. That's what you can do. That's your advantage. So another thing that institutions will look for is a material change in earnings. And this is what we call a breakout year. So what you do is you look back and you look at the annuals and you see if maybe the stock has been in a range. The earnings have been dormant and been flat, or maybe just slow growth. Maybe they've been growing at X percentage, and then suddenly you get a breakout out of that range. This is just another form of acceleration. Everything I've been talking about since we started talking about acceleration is all based on acceleration. So here we've got acceleration. So take a look at this example right here. 2006, 23 cents a share. 2007, 26, 2008, down a little bit, 18, 2009, 32 cents a share. Not much, right? For 4 years, it's basically range bound. And then all of a sudden, boom, $1.32, up 300%. And the estimate for the next year is up 47%, which still could be conservative. That's a breakout year. And you're going to find a lot of stocks. You can even look at the estimates. Sometimes if a stock is setting up and it's setting up technically, you can look at the estimates. You might already see some accelerating quarters, and it hasn't really shown up in the annuals yet, but you'll look at the estimate. You've got acceleration in the quarters, you've got the stock setting up, and you look at the estimate, and the estimate is going to be a big breakout year. Now it's just a matter of following the stock and making sure the quarterlies are playing along with that, with that picture. Here's an example going back. We're going to look at Gilead again. Remember, we had the quarterlies, right? Here's the quarterlies. Now, right here, see the estimate? The quarterlies are coming in, but if you look at the estimate right here, $1.85, $1.93, $1.95, $2.04, almost no earnings movement at all for 4 years, $8.01. Pow, up almost 300% breakout year. And now the stock's breaking out of the base and everything is culminating and coming together to that one specific day that you're going to be buying at, which that's later. We're going to talk about the technicals. But so let's keep moving here. Okay, so now another way that you can look for earnings acceleration is looking at the current earnings versus the growth rate. Very often this will happen in turnaround situations where you've got companies or a whole industry that fell on hard times. And now you're getting a turnaround. Maybe there's, the business dynamics have changed, or there's a new CEO of a company that's refocusing their strategies. Whatever it is, there's a company that wasn't doing well, suddenly is starting to do well. Now, here's the caveat. And I think we talked about this earlier. With turnarounds, you're going against what we call easy comps. So when you have a growth rate, especially if it's a very negative growth rate, let's say the growth rate is negative 50%, and now you start to see the earnings come in, well, you're going against very easy comps. They call them easy comps, which just means that you're comparing the current earnings to a small number or maybe even a negative number. So it's going to be very easy to appear to have a big earnings report. So with turnarounds, what we found is you generally want to have 2 quarters of triple-digit earnings before you consider the stock. Certainly one with at least the estimate of the next quarter being very strong. But generally you want to have a couple of quarters of very strong, and that's looking at your growth versus the growth rate, your current growth versus the growth rate. In this is a hypothetical situation, but you can see the 5-year growth rate is negative 7%. The 3-year growth rate is 12%. Nothing to write home on either of those, right? But look at the recent couple quarters, up 44, up 183, and then the next quarter is estimated to be up 900%. So huge acceleration from minus 88 to minus 7. So you've got the sequential. You might even have the breakout year, and now you've got acceleration versus its growth rate. This would be hitting on all cylinders of acceleration. Go ahead, Dave.
I would say that also when you're talking turnaround situations, that you want to recognize these in their first or second quarter. Because if you wait until this has a great growth record and has been coming through with 4 quarters of earnings or even 6 quarters of great big earnings, lots of times these turnaround situations have already had their move. And you'll start seeing them show up technically after that first earnings report. People are going to recognize, hey, there's something going on here, and you're going to see that stock starting to take off. But especially in turnarounds, you got to catch them in those first 2 quarters of a huge turn in their earnings.
Right. And you're going to be using this all together with if you're using MarketSmith, of course, we have the trend templates. You can use what Dave was talking about earlier about having that 1-month trend template where you get those early turns, and you'll pick up a lot of turnaround situations with those early turns. You'll see technically the stock starting to turn, and you can go and see if it's got the earnings. Now, going back, we've been doing this for a while, but I use this page from the 2013 Master Trader Program workbook. Basically, I picked the stock that particular day, or that particular Master Trader Program, and I picked Home Depot as a stock that I said, this is one that meets the criteria that I would look for right now. And I said, we'll revisit this a year later. When I come back, we'll see how it performed, and we'll just do like sort of an exercise here. So I picked Home Depot. Now you can see here it has a 4% growth rate, right? But see the earnings in the most recent quarters. You've got a couple quarters here: 39, 30%, 17%. Average of 29%. So that's a big acceleration versus the growth rate. That's one of the reasons why I picked it. You also can see that you've got the earnings in the quarterlies, 11, 19, 18, and then 39, 30, 17. You've got that if you were to average these out like we talked about, you've got acceleration in the quarterlies, right? So relative strength, 90, great. That's great. It's coming out of a little base here. You've got a bunch of things that really look pretty strong here for Home Depot. Now, the thing that I want to show you, we're gonna go back here, and we're gonna go back to talking about valuation and talking about analyst estimates. This is where I want to show you. Remember, I said there's the opportunity is in the analyst being conservative. and them not being able to predict, 4 quarters, however many quarters out, however many years out. Well, take a look here. PE ratio is 21, right? The estimates, these are estimates, earnings estimates for the year, 297 and $3.37 for 2014, right? The visibility here, 2013 is right around the corner. You're in 2013, and 2014 is the very next year. Okay, we're going to fast forward here 1 year later. All right, this is looking at the year later. The stock now had a 90 RS, right? That's what it was when I showed you the other chart. Just going back here, 90 RS, right? 90 RS. Look, the stock made a pretty good size move here. It went from, I don't know, what was it, maybe $55 up to 90 or so, almost a double. But look, the PE is exactly the same. It didn't change. It's still at 21, right? Growth rate was 4%, right? We go back to the other chart, 4% growth. Now, growth rate is 23%. See, because the earnings came in, right? But here's the real key. The earnings estimates, if we go back here and we look, there were 297 and 337, right? That's this red circle right here. 297, 337. A year earlier, those were the estimates. Look what actually came out. 307, 376 in 2014. See, there were, not only were they off, but the further out you go, the more off they were. The analyst estimates were conservative. They're way conservative, and this is on a stock that is widely followed. Which they're covering this thing with all types of forensic accountants and all kinds of MBA, CFAs that are following this, and they can't get it right. Now, this is a stock that's only growing at 20%, 30%. Now, you kick that up to 100% growth, and they're not going to have a clue. They're not going to have a clue as to how to value this thing. And that's why they can make these huge moves, because they're completely inefficiently priced. All right, let me show you on the flip side now. This will really drive the point home. That next year, I did the same thing again at the 2014 Master Trader Program, except this time I said, I'm going to point on a stock that I think we should avoid here. That's the exact opposite of the criteria to buy, but it's in a stage 4 downtrend, and I would just avoid this stock. This is one that we don't want to be in. Okay, so we're already, you look right here, we're in a stage 4 downtrend, right? The relative strength is a 3, right? That's basically the highest relative strength in reverse. It's almost the lowest relative strength, right? PE is 22. You can see the negative earnings. You went from nice strong earnings of 97, 70, 69, these strong earnings to negative earnings. Sales also came down dramatically. Let's look at the estimates, all right? So we got 2014 of $2.67, 2015, $3.22, right? Let's make a mental note of that. Now, let's move forward and see what happened to this stock. Wow. I mean, you want to talk about a pretty clear picture here of making my point. So PE is 22. This right here is where it was right here. This is that chart, right? So we're fast forwarding to the next page. We're on page 90. So stock rallied a little bit, but ended up getting cracked pretty hard and is down substantially from there. And the PE is now 86. So how does a stock decline? They make this giant decline, and it's way more expensive because the earnings, look at the earnings, losses, right? Now it's saying NA because now it's negative. They're negative numbers. They're losing money. So you can't, there's not even a number that you can compare as a percentage. But here again, here's the real key. $2.67, 322, right here. There it is. 267, 322, right? Look what actually came out. 231, negative $1.20. They had this company earning $3.22 in 2015, and it actually lost $1.20. Huge.
And that's why, especially when a stock is in a stage 4 downtrend, you listen to the stock and not listen to the estimates, because the stock is telling you that they're starting to have problems, and it certainly came true.
And the analysts are slow to react. That's why you're listening to the news and you're watching Kramer and whatever your newsletters, and you're getting all this information. Believe me, you're going to do much better when you learn how to make these decisions based on the chart and the numbers, and you learn how to focus on these key things that we're telling you, that this is how you're going to beat the pros, get the big returns, manage your risk, and astonish people with, how do you do this? You must have this crystal ball. No, you know what to look for. You know how to respond to it. And you know how things work in the real world. See, this is real world. This is how it really works. And this is how I do it. This is how Dave does it. All right. So go ahead.
Yeah. The other thing, when a stock starts in a downtrend, and the outlook for the company starts changing, I think analysts are almost reluctant to say negative things. I mean, you've seen in the past they would show how many positive reports there were out on Wall Street, and it was in the 90+%, of all reports are positive. And companies usually don't put out negative reports, and they also don't want to say negative things about companies, because they're actually going to get out of their good graces, and the company might not talk to them in the future and give them an idea of what's happening. So they're very, very reluctant to put negative reports out and even put out negative estimates.
There's a lot of politics behind this, and that's basically what David is saying. And so let's assume this was Amazon. Here's where an analyst is going to have a very hard time saying negative things about a company that has had declines in the past. It probably had a bunch of these declines, 20, 30% declines, even 50% declines that the stock came right back from and then went up 500% after that, burned time and time again, where if they got negative, they would have been burned hands down. Well, that's what happens now that the stock finally tops, and a lot of times they're actually putting out as a buy. You'll find that these brokerage firms are buying these declines in these big names because they're looking myopically, and they're so convinced that this company is so strong that. And then maybe the stock bottoms for a little bit, but that's when the trouble starts brewing. And then finally, when it's getting really obvious and the numbers really start turning, then all of a sudden, everybody starts to agree. And now that whole agreement theme happens all over again. And now you set up for a positive surprise. You see, it's the exact same thing. Remember, we're going right back to that maturation of the earnings maturation cycle with the surprise models, and going from value to growth, from growth to value, with the surprises on the upside, surprises on the downside. That's all set up and driven by the analyst being slow to react, and the stock not being efficiently priced. And the higher the growth, the more difficult it's going to be to value that stock, and the more inefficiently priced it's going to be. And that's why the high growth companies can make these huge moves. You get into a company that's growing at 8% a year and it's a utility, that can be valued pretty accurately. All right. That's why we're not going to bother with that. We're going to go in areas where there's potential inefficient pricing, and we can get this monster move, or even a velocity move where the stock doubles or triples just in a few months. And that's where you make the big money, because you're compounding very rapidly. So this should really, whenever I show these slides right here, and I show this estimate and show how off, the analysts were, it just light bulbs always go off. This is whenever we do the live events, people come up to me afterwards and they're like, wow, that really made a big point, and really let me see, what's going on here, and why these stocks are able to make these moves. So real quick, I'm not going to go over these, but how do you know if an earnings report is really great? This is 7 things that you can look at to judge if an earnings report is a decent earnings report. And like David said, what's really important is the response, and the response to the earnings, and the response to guidance. If the initial response is very important to see how it initially responds, but what's even more important is subsequently, is there subsequent strength? And if the stock does come off on the earnings report, is it resilient? Does it come back very quickly? Looking here at Netflix, you can see they had an earnings report. It gapped up big and then pulled back a little bit, and it was able to get right back a new high ground. And that was it. You got that post-earnings drift, because this report was a good report. It truly was a good report. Now, you could have had that same report and the same news on the surface, but if the stock broke, that's not going to be a good report. Even though it's the exact same news, depending on how the stock acts, if that stock was down 15%, I'd conclude that that's a bad report.